What if the investment strategy that millions of Americans believe is completely safe is actually costing them thousands of dollars every single year? And almost nobody is talking about it. That's exactly what we're diving into today here at MoneyMindDaily, where we expose the hidden financial truths that separate people who actually build wealth from everyone else who just thinks they are. By the end of this video, you're going to know the specific index fund mistake that's quietly draining average investor accounts, the legal way that fund companies exploit your trust, and the 3 simple fixes that could literally save you tens of thousands of dollars over your investing lifetime. Let's start with a picture most people recognize. It's a Tuesday morning in New York City. James is 34 years old, sitting at his kitchen table in his apartment in Brooklyn, coffee in hand, feeling genuinely good about his finances for once. He opened a brokerage account 3 years ago, threw his money into a total market index fund just like every finance influencer told him to, and he hasn't touched it since. He thinks he's doing everything right. He's not timing the market. He's not picking individual stocks. He's diversified. He's passive. He's patient. By every measure of conventional financial wisdom, James is a responsible investor. But here's what James doesn't know. He's been quietly hemorrhaging money for 3 straight years. Not because the market went down, but because of a set of invisible structural mistakes buried inside the very funds he trusted. And the worst part, most financial advisors won't tell him this because it's not in their interest to do so. This is not a fringe theory. This is not a scare tactic. This is backed by hard data. A landmark study from S&P Dow Jones Indices found that over a 15-year period, approximately 92% of actively managed large-cap funds underperformed the S&P 500. That research is what sent a whole generation of investors rushing into index funds. And rightfully so. Index funds are genuinely powerful tools. But here's what that same crowd missed. Not all index funds are created equal. The differences between them are subtle enough that most people never notice, but significant enough to cost the average investor anywhere from $10,000 to over $60,000 across a standard 30-year investment horizon. We're going to break down exactly where that money goes, how the system is structured to make you ignore it, and what you can do starting today to stop the bleeding. The first place your money quietly disappears is something called the expense ratio trap. Now you've probably heard of expense ratios before. Most people have. They know they should look for low fees. They nod their heads when a financial content creator says to find funds under 0.5%. But here's the mistake that actually kills most average investors. They compare expense ratios without comparing. Thank you so much for watching. If this video helped you, please hit like, subscribe, and share it with one person who needs to hear it. See you in the next one.